In this video, we will take a look at the advantages and disadvantages of value at risk, VaR. This video will be helpful for candidates who are preparing for the FRM Part 1 exam, candidates preparing for the FRM Part 2 exam, and also candidates who are preparing for the CFA Level 2 exam. Okay, let's begin with a quick look, a quick recap of this concept of VaR. Now, a textbook definition of VaR simply states that it is essentially a loss number realized over a certain period or horizon, and this loss number is not expected to be exceeded at a certain chosen level of confidence. Okay, to understand what this definition means, let's take a look at this very simple loss distribution. Okay, now we will not worry about the position that created this loss distribution for us. This position can be a very simple position, such as, for example, a position in a single stock. This position can very well be in a very complex financial position or a financial contract. Okay, all we will assume at this stage is that this loss distribution is for losses which materialize over our chosen time period or horizon. Now, if we have to estimate or read off the VaR for this loss distribution, it will simply amount to picking that number on the horizontal axis such that it divides this loss distribution into two parts, the body and the right tail. Okay, this division of this loss distribution into these two parts is done in such a way so that the probability, the area in the body of the distribution is equal to my chosen level of confidence, denoted by lowercase c, and the area, the probability in the right tail is equal to my chosen level of significance, denoted by alpha. Now I know this, that c is equal to 1 minus alpha. Okay, so as per this given loss distribution and in this diagram, my VaR is simply this point which I have highlighted here. Okay, and based on what I have stated till now, this point is nothing but the quantile for this distribution for a probability which is equal to my chosen level of confidence. Okay, the C quantile. Okay, this is that loss number, the probability of whose being exceeded is equal to alpha, and the probability of whose not being exceeded is equal to my chosen level of confidence. Okay, this then tells me that for a loss distribution which has been given to me, my loss which is equal to Q corresponding to C is my VaR. Okay, now if instead of a loss distribution, let's say you were given a profit distribution, how will you read off the VaR from this distribution? Well, I know this, that profit is nothing but -1 times the loss. Therefore, my profit distribution is nothing but my loss distribution which has been flipped around a vertical axis. Okay, so if I have to read off the VaR from my profit distribution, again on the horizontal axis, I will locate that number which this time for my profit distribution will divide this distribution into two parts, the body and this time the left tail, such that the area in the body is equal to my chosen level of confidence and the area in the left tail is equal to my chosen level of significance. Okay, this point then which divides this distribution into body and left tail will be the quantile for this distribution at a probability equal to my chosen level of significance. Okay, and because VaR is a loss number and here this quantile is a profit number, therefore VaR in this situation will be minus of the alpha quantile read from this distribution. Okay, this is a quick recap of this concept of VaR. Now let's do this. Let's quickly state a few advantages of VaR which stem from the definition of VaR itself. Okay, and the first advantage is that it is a rather simple measure of risk. Okay, if you, let's say, you are a decision maker in your organization, you won't have difficulties understanding what this risk measure is all about and how to estimate this risk measure for such simple situations. Okay, VaR as a risk measure will tell you what is that threshold loss number which, if it were to be exceeded, sound like you have entered into dangerous times. Okay, and I'm talking about dangerous times relative to the capital that you have in place. Okay, so VaR as a risk measure helps answer this simple question as to how bad can things get. Okay, this is my first advantage. My second advantage, which is related to the first one, is that VaR is a rather holistic measure of risk, and it can be easily communicated to a wide audience in your firm. Remember, I had said this, that this loss distribution can be for a very simple financial position. It can very well be for a very complex financial position or contract. Okay, my financial position can be sensitive to multiple risk factors, to multiple risk drivers, right? And I can define my adverse scenarios by pushing these risk drivers up or down, right? But what VaR does is that it distills all this information about my various risk drivers, about the dependence between these risk drivers, about the direction in which each of these risk drivers have to respectively move in for me to experience an extreme loss, into this single number, which is my VaR. That's why I called it a very holistic measure of risk. Okay, and this measure of risk, therefore, becomes easy to communicate to a wide audience. Okay, then the next advantage of VaR is that it's a quantile-based measure of risk. In this situation, it was the C quantile. In this situation, it was minus of the alpha quantile. Because VaR is a quantile-based measure of risk, it is not perturbed by or influenced by extreme losses, by outliers. Okay, this is an advantage of VaR. Then, the fourth advantage of VaR is that it can be easily back-tested. It's easy to verify the reliability of your VaR number. If on a daily basis, let's say, I have my estimated VaR with me, and also for that same day, I have the actual loss which materialized, I can compare the two and I can check if an exception happened on that particular day or not. If your actual loss turned out to be greater than the VaR, it means that an exception happened on that day. What you can then do is that you can note the number of exceptions over a given window of time, and based on that number of exceptions, then you can conduct hypothesis tests to check the reliability of your VaR number. Okay, these are my advantages which come from the definition of this risk measure itself. Okay, next, let's do this now. Let's list a few advantages which come from how VaR is put to use. For this purpose, let me very quickly depict in front of you a simple practical situation. I'm talking about a firm here which has a trading division. In this division, let's say I have two desks, an equity desk and a fixed income desk. Within the equity desk, let's say I have two portfolios. an equity cash portfolio, which includes positions in single stocks and in equity indices, and I have an equities options portfolio. Okay. Then in the fixed income desk, again, let's say I have two portfolios. I have a bonds portfolio, and let's say I have a derivatives portfolio within which predominantly I have swap positions. Okay. Now, the managers of each of these portfolios may have their own respective chosen measures of risk, which are appropriate risk measures for each of these different types of positions. A manager of this equity cash portfolio, let's say, wants to work with standard deviation or beta as a measure of risk. Let's say a manager of this equity options portfolio wants to work with different Greek measures such as delta, gamma, vega, rho, etc. The manager of this portfolio wants to work with, let's say, duration and convexity as the chosen risk measures. The manager of this portfolio, let's say, wants to work with DV01. Okay, so all I'm saying is for all these different, types of positions, there might be more natural, more appropriate respective measures of risk which are being used. Now, once VaR enters the picture, it provides a universal metric, a universal measure of risk, which can be calculated for each of these very different types of positions. And this universal measure of risk then helps you compare the risk of very different types of positions. Okay, this is my first advantage of VaR in this camp. My second advantage of VaR is that it can be measured at any level. I can calculate VaR for an individual stock position sitting in this portfolio. I can calculate VaR for an individual swap sitting in this portfolio. I can calculate VaR from my equities desk. I can calculate VaR for my overall trading division. It can be measured at any level. Okay. Then the third advantage in this camp is that VaR can be both aggregated as well as disaggregated. If I have VaRs available for, let's say, each of these portfolios, given the correlation, or let's say given the dependence between the constituents of these portfolios, I can aggregate these individual VaRs to go all the way up and calculate the VaR for my trading division. Okay, so VaR can be aggregated. If I have the VaR at this level, which is my trading division, I also have access to tools which can help me drill down into this aggregate VaR and try and figure out which are all the risk factors, the risk drivers, which are contributing the most to this VaR, or let's say contributing the least to this VaR. Okay, so I can drill down or I can disaggregate VaR as well. Okay, then given the fact that I can calculate VaR at this rather high level in this tree which I have here, VaR can help me place macro level hedges. VaR can help me in risk budgeting. It can help me check if I am allocating the right amount of capital to each of these activities which I have in this trading division relative to the risk that they are, getting exposed to and the returns that they are generating. I can use the VaR to also, be a measure of or a basis for performance evaluation and remuneration of my risk takers. Okay, these are my advantages of VaR on the basis of how I put it to use in a practical context. Okay, now let's do this. Let's balance out things and now list out a few disadvantages of VaR. The first disadvantage of VaR is that it can be misunderstood and or gamed in practice. Now, we already said this, that VaR is a very simple risk measure. But what VaR can do is that it can kind of oversimplify things. Decision makers in any organization should clearly understand this, that VaR is by no means the maximum possible loss. VaR can very well be exceeded. Okay, so don't misunderstand the information which VaR is trying to convey. Also, let's say if you have risk limits in place which are based on VaR, your risk takers can very well game this situation in such a way so that they put on positions which let them stay within these risk limits but still expose the entire institution to unacceptable levels of risk. Okay, so VaR has this disadvantage that it can be misunderstood and or gamed. Okay, then the second disadvantage of VaR is that calculating or estimating VaR requires you to make a number of subjective decisions and also assumptions. If you have to calculate VaR, you have to first and foremost choose the horizon you want to work with. You have to choose the level of confidence at which you will calculate your VaR. These two are rather subjective choices. Then you have to make assumptions about what random variable would you want to work with. Do you want to work with losses? Do you want to work with profits? Do you want to work with returns? If returns, do you want to work with the arithmetic return, with the geometric return, right? Then you have to assume the distribution you want to work with. If you want to work with the normal distribution, be prepared for an underestimation of the likelihood of extreme losses happening. Okay, this is my second disadvantage of VaR. My third disadvantage of VaR is that it by no means encapsulates all possible risks that you are exposed to. Okay, your VaR may have missing risks. And notably here, I'm talking about liquidity risk. If let's say this loss distribution is for a single stock position, in arriving this loss distribution, I would have assumed that I'll be liquidating my position at the end of my chosen horizon. And if in this loss distribution, I am assuming that liquidation of this stock position happens at the mid price, then this VaR calculation has not taken into account liquidity risk. Okay, that means your VaR has to be duly adjusted for liquidity risks. Okay, then the fourth disadvantage of VaR is to do with the approach that you've chosen to work with and the precision of the VaR number that you've arrived at. First things first, you have to make sure that you have enough observations, enough data points when you go about estimating your VaR number. If you have few observations to play with, the number of observations which fall in the tail of the distribution which you are trying to generate will be even fewer, right? And this will make the VaR estimate that you arrive at rather imprecise if you are working with a high level of confidence. Okay, then let's list a few disadvantages associated with the approaches which are available to us. If you make use of the historical simulation approach, one has to make sure that you are working with the right historical data. One has to make sure that the historical or past data that you are working with captures the entire variation, I mean all possibilities associated with the scenarios that you will encounter in the future. Okay, if at the moment you are passing through, let's say, a low volatility period, estimating VaR using this historical data which comes from a low volatility period will underestimate your VaR and hence underestimate the losses that you will encounter in the future when volatility reverts back to what can be called normal volatility. Okay, then if you choose, let's say, the delta normal VaR approach as your chosen approach, you have to ensure that the position that you're working with is sufficiently linear, because delta normal VaR is more appropriate for linear positions. If you've chosen to work with Monte Carlo simulations as your chosen approach, you have to ensure that you have the computational capacity in place to calculate VaR using this approach, because we know this, that Monte Carlo simulation approach is computationally quite intensive. Also, when working with the Monte Carlo simulation approach, one has to ensure that you have the right variance reduction technique in place so that your standard error of your VaR is kind of limited and not too high. Okay, then the next disadvantage is that VaR may not be coherent, and this happens because VaR may not be sub-additive. What does that mean? Coming back to this situation, if VaR is not sub-additive, what you will experience is that VaR for this level, which is my equities desk, might turn out to be higher than the sum of the individual VaRs of this portfolio, my equity cash portfolio, and my equity options portfolio. Okay, the sum of individual VaRs for these two portfolios may be lower than the VaR for the equities desk, which means that VaR for this level is not duly rewarding the diversification benefits offered by these two portfolios combined. Okay, so VaR may not be coherent. The last disadvantage of VaR, which we have in this video, is that it may have destabilizing effects for the entire system. Now, why does this happen? If, let's say, you have a number of market participants who are using VaR as their chosen risk measure, and based on VaR, they are putting up macro hedges. If VaR were to fluctuate over time, these hedges are adjusted, and if everybody in the market is adjusting their respective hedges based on the same chosen measure, which is VaR, this coordinated response by many different market participants will have this impact of making uncorrelated risks rather correlated. Okay, so VaR can have systemic effects as well. Okay, this video was all about understanding VaR as a risk measure and also highlighting the various advantages and disadvantages of VaR.